Investing often feels like a daunting mountain to climb, especially when the idea of starting with just $100 seems almost laughable. The misconception that you need a fortune to begin is one of the biggest hurdles for new investors. The truth is, anyone can start investing with a modest sum, and it's about making the most of that initial capital that matters. Understanding the fundamentals is key. Investing is simply putting your money to work for you, aiming to grow it over time. The journey may seem overwhelming, but breaking it down into manageable steps makes it achievable. The first step is to understand the different types of investments available. Whether it's traditional assets like stocks and bonds, pooled investments such as mutual funds and ETFs, or alternative options like real estate, commodities, or even digital assets, each has its own characteristics. It's important to grasp the basics of how these investments work before committing any capital. Each investment type has its own risk and potential for return, with some offering more stability and others providing higher growth opportunities, but with greater uncertainty. Being informed about these options is crucial to making decisions that align with your financial goals and risk tolerance. Before even thinking about where to put that $100, establishing clear investment goals is crucial. Ask yourself what you want to achieve. Are you saving for a short-term goal, like a vacation or a new gadget? Or is this investment part of a long-term strategy for retirement? Understanding the timeline for your goals helps determine the types of investments that align with your objectives. Short-term goals might be better suited for less volatile investments, while long-term aspirations allow for more risk-taking, as there's time to ride out market fluctuations. Setting these goals not only provides clarity, but also keeps you motivated as you embark on your investing journey. Before diving into investments, creating a strong financial foundation is essential. This means paying off high-interest debt and establishing an emergency fund. Debt, especially with high interest, can quickly erode any gains made through investing. It's difficult to grow your wealth when a significant portion is going toward interest payments. Building an emergency fund, ideally covering 3 to 6 months' worth of expenses, provides a safety net that allows for more aggressive investing without the fear of financial instability. Once the foundation is set, the next step is to open a brokerage account. Choosing the right brokerage is vital. Look for platforms that offer low fees, user-friendly interfaces, and educational resources. Many brokerages today allow you to start investing with little to no minimum deposit, making them accessible for someone starting with $100. With just $100 to invest, it's essential to have a strategy. One popular approach is dollar-cost averaging. This strategy involves consistently investing a fixed amount of money over regular intervals, regardless of market conditions. For example, investing $10 weekly or monthly helps reduce the impact of volatility. When the market dips, your investment buys more shares, and when prices rise, you purchase fewer shares. This method mitigates the emotional stress of trying to time the market. It encourages disciplined investing, allowing new investors to build their portfolios steadily over time. Dollar-cost averaging is a proven strategy that many seasoned investors advocate for its effectiveness in building wealth gradually. Research is vital in the investment world. Gaining a solid understanding of different investment options, whether stocks, bonds, real estate, or alternative assets, can significantly impact overall performance. Utilizing tools like financial news websites, market analysis platforms, and investment forums can provide valuable insights into trends, performance metrics, and economic indicators across a range of asset classes. For beginners, focusing on a few key metrics relevant to each investment type can simplify the research process. For instance, when looking at stocks, consider earnings growth, debt levels, and market position. In real estate, factors like location trends and rental yield are crucial. Following market news and trends that can influence various investments is essential for making informed decisions. Staying updated on economic developments, regulatory changes, and sector-specific news allows investors to navigate the landscape with greater confidence, regardless of the investment strategy chosen. Now that a foundation has been established, it's time to explore various investment options that can be pursued with just $100. Investing in individual stocks can seem intimidating, but many online brokerages allow you to start with a small amount. The first step is to identify companies with solid growth potential. Focus on industries you are familiar with or passionate about, as this can make the research process more engaging. Look for companies with a strong track record of revenue growth and sound management practices. Start by buying fractional shares, which allow you to invest in high-priced stocks without needing to purchase a whole share. This means you can diversify your stock investments even with a limited budget. For instance, if a stock is priced at $500, investing just $100 allows you to own a fraction of that share. Over time, as these companies grow and thrive, your investment can appreciate significantly, paving the way for greater returns. ETFs are a popular option for beginners because they offer diversification. With just $100, you can buy shares in an ETF that tracks a broad index, like the S&P 500. This allows you to invest in a variety of companies without needing to buy individual stocks. The beauty of ETFs lies in their ability to spread risk across many assets. This means if one stock underperforms, the overall impact on your investment is minimized by the performance of other stocks within the fund. Additionally, ETFs often come with lower fees compared to mutual funds, making them a cost-effective way to build a diversified portfolio. Many brokerages offer commission-free trading for ETFs, allowing investors to buy and sell shares without incurring hefty fees. With this approach, your $100 can be split among several ETFs, giving you exposure to different sectors or regions, further enhancing your investment strategy. REITs allow you to invest in real estate without the need for large amounts of capital. They provide exposure to income-generating properties and often pay dividends, making them an attractive option for small investors. Investing in REITs can be done through brokerage accounts, where you can buy shares in these trusts just like stocks. REITs typically invest in various types of real estate, including residential, commercial, and industrial properties. By doing so, they generate income from rents or property sales, which is distributed to shareholders in the form of dividends. This avenue allows you to tap into the real estate market without the complexities of property management. Moreover, REITs can provide a hedge against inflation, as property values and rents tend to rise over time. For those starting with $100, choosing a REIT with a solid track record of performance and stable dividends can offer both income and potential capital appreciation. Cryptocurrencies have gained popularity in recent years, attracting many new investors. Starting with just $100, it's possible to buy fractions of various cryptocurrencies like Bitcoin, Ethereum, and many altcoins. While the cryptocurrency market is known for its volatility, it offers significant growth potential. When considering cryptocurrencies, it's essential to do thorough research to understand the technology behind each coin, its use cases, and the market dynamics. Platforms like Coinbase and Binance allow you to start investing in cryptocurrencies with minimal fees, making it accessible for beginners. One strategy for investing in cryptocurrencies is to diversify your portfolio by investing in multiple coins rather than putting all your money into one. This approach helps mitigate risk and increases the potential for returns. However, it's crucial to remember that the cryptocurrency market is highly speculative and prices can fluctuate dramatically, so investing only what you can afford to lose is wise. These automated investment platforms manage portfolios for you based on your risk tolerance and financial goals. Many Robo-Advisors have low fees and allow you to start investing with just $100, making them a convenient choice for beginners. Robo-Advisors typically use algorithms to create diversified portfolios comprised of ETFs and other low-cost investments. This means that even with a small initial investment, you can benefit from a well-structured investment strategy without the need for extensive knowledge or experience. Additionally, Robo-Advisors often rebalance your portfolio automatically, ensuring that your investments remain aligned with your risk tolerance over time. This hands-off approach allows investors to grow their wealth without the stress of active management. This investment avenue allows you to lend money directly to individuals or small businesses through online platforms. You earn interest on the loans, which can generate passive income. While it involves risk, it can be a way to diversify your investment strategy. Many peer-to-peer lending platforms allow you to start with as little as $25 per loan, meaning that your $100 can be spread across multiple borrowers, further reducing risk. As a lender, you can choose which loans to fund based on factors like credit rating, loan purpose, and term length. It's important to remember that while peer-to-peer lending can yield attractive returns, there's also the risk of borrower default. Conducting thorough research on the platform and the borrowers can help mitigate this risk. Investing isn't a get-rich-quick scheme, it's a long-term commitment. As the adage goes, patience is a virtue, and it holds particularly true in the investment realm. The stock market fluctuates, and it's easy to panic when prices drop. However, maintaining a disciplined approach is key to weathering market storms. The compounding effect of returns cannot be overstated. Over time, investments can grow exponentially, but only if they're allowed to mature. This means resisting the urge to make impulsive decisions based on short-term market movements. Trust in the process, stay informed, and keep the focus on long-term goals. New investors often fall into traps that can hinder their progress. Emotional investing, for instance, can lead to poor decisions based on fear or greed. It's essential to stick to the plan and avoid chasing trends. Overtrading is another common mistake, driven by the desire to capitalize on every market movement. High trading fees can erode profits, especially when starting with a limited budget. Another pitfall is ignoring diversification. Putting all your money into one stock or asset class can be risky. Diversifying across different sectors or asset types reduces risk and provides more stability to a portfolio. With knowledge in hand, the time to take action is now. Starting with just $100 is not only possible but a smart way to begin the investing journey. It's about taking that first step, setting goals, and being open to learning along the way. Investing is a journey filled with lessons, and starting with a small amount allows for growth without overwhelming risk. Investing isn't just for the wealthy, it's for anyone willing to put their money to work. With diligence, research, and a commitment to learning, that initial $100 can lay the foundation for significant financial growth. The key is to start, stay consistent, and embrace the process.